Hey everyone, thanks for joining us. I have to give this to Perth. Perth won the skateboard yesterday from the, you did. We're doing a little thing where if you post a piece of Edify swag and get more links than anybody else for the day or likes for the day. So we're here to talk about emerging markets, and we're going to have a little bit of a debate because we have two folks on stage that have pretty radically different approaches to, frankly, how to think about investing outside the United States, much less how to think about the specifics of any individual emerging market. I'm going to ask each one of them to give a little bit of their priors here, where they're coming from, how they think about the space. You can talk about your products or not. I'll cut you off if you get too long. And we're going to have a bit of a debate about approaching the emerging markets. We also want you guys to be part of the debate, so please do go ahead and use Slido. Get those questions in. When we get to about 10 minutes to go, we'll start trying to answer some of those questions if we can see them on the screen. So Perth, why don't you give us a start? Talk about what you're doing with the Freedom 100 Index.
Sure. So we run the Freedom 100 Emerging Markets Index and ETF. The ticker is FRDM. And what it is a freedom-weighted emerging market strategy. So instead of market capitalization weighting, which leads to a high concentration in autocracies, so a lot of China, Russia, Saudi Arabia, not so much Russia anymore, but Egypt, Turkey, and so forth. Instead, we would freedom weight, so the freer countries get a higher weight instead of the bigger companies and countries getting a higher weight. So that way we can invest in emerging markets without funding autocracies and also give a higher allocation to the freer countries where we expect to see the growth going forward.
Great. I'm going to come back to you with the 400 questions, but not just yet. Jason, talk a little about what you're doing at Railiant.
Got it. So we also have a emerging market ETF, RACI and RAD, Railiant China and Railiant emerging market, RAI. And the way we look at emerging markets is really just focus on growth. You know, if a democratic country has tremendous amount of corporate earnings growth, we'll be overweight that country. Sometimes a more autocratic economy might have significant growth over a short spurt of time. There's a point in time when Taiwan was autocratic, is where I came from, and certainly China is now quite autocratic, and they both have phenomenal growth, and so we'll take advantage of that as well. Of course, we like emerging markets because those are markets that are very inefficient. So not only could the beta be interesting, you get a lot of growth and diversification, but the fact that alpha is probably, EM is probably the last place where you can find alpha, given how inefficient those markets are, how many retail speculators there are. So we're quite focused on the part of EM that is liquid and retail dominated.
Got it. Okay. So that's a good framing here. Let's dig right into the heart of this issue. You both used the word autocratic in discussing the potential emerging markets one could invest in. Obviously, China is the elephant in the room, if not the elephant on the globe. So Perth, go at it with Jason here. So, why shouldn't you be investing in autocracies, right? And I'd much rather listen to you two talk about it than me. So, I think you have a fundamental difference of opinion here. So let's explore that. Perth?
Yeah, so really the biggest issue here with autocracies, and besides the moral issue there and all the things that they're doing in the world, is that in these types of autocracies, a lot of these companies cannot act in their own or their shareholders' best interest. They have to put the interest of the state first. So you have a company like Tencent, they own, let's say, WeChat, and Chinese government wants customer data so they can crack down on dissidents. WeChat or Tencent is going to have to give them that information. Or as lately we've seen in the tech crackdown, if a tech founder says something that the government doesn't like at a conference, then they could crack down on your IPO or disappear your founder, things like that. So these are risks that we don't want to be exposed to in emerging markets. And we think that in emerging markets, there's so many of these types of autocracies and so many of these tail risks that previously investors have miscalculated, or actually Wall Street has miscalculated, because you hear people like Larry Fink saying, oh, markets like authoritarianism. But actually, markets don't like authoritarianism. They like, what he's trying to say is they like certainty. But authoritarianism does not provide certainty. It's actually the opposite of certainty, because you have this capriciousness in the government that is a risk there's no way to predict or calculate.
Jason, what would your counter be?
So first of all, I want to agree with Perth. So I'm gonna go.
Okay, good.
I'm gonna go easy and start there.
Start nice.
Yeah. So absolutely. I mean, you don't want to be in any sort of regulatory environment where the regulator is capricious. Now, when you look at data, it is universally true that almost all emerging economies have very capricious regulators, democracy or otherwise, right? Because within the emerging basket, right, you kind of have South Korea, you kind of have India as, very, very democratic. In fact, India is probably the most democratic country by size and the number of parties, right? And they have very capricious and very anti-business regulations as well. So we are opposed to anything that's anti-business, anti-intellectual property, that adds red tape, bureaucracy, that is sort of not conducive to business and property ownership. And so from our perspective, it is less about the political organization. It really is looking deeper and looking at sort of what creates a anti-success regulatory environment. And so, being active, and this is perhaps the difference between kind of an active approach and a passive approach, is being active, you're able to sort of get to the source of what harms stock market performance.
So let me reframe the question again. So there's been a lot of discussion about ESG, and you can't throw anything without hitting an ESG conversation here. And I think it's fair to say there's a bit of an ESG versus not anti-ESG, but sort of not ESG approach here. Why am I wrong about that? Isn't this effectively kind of like an ESG approach to emerging markets and a just financials overall approach to emerging markets? Maybe Perth, you can start with that one.
Yeah, first I want to address kind of what Jason said here. So once me and Jason had a conversation, by the way, we are actually great friends, and he's like a brother.
We know
in
each other
history,
forever.
Jason once told me, okay, so in China, and let me know if this is wrong, in China, you don't want to be like the number one top dog. You want to be like somewhere in the middle, so you don't get, a target on your back. You don't attract too much attention, right? So, and I know that you now have most of your business in China, so you're also somewhat limited to what you can say. But, that's the type of environment that we're operating in an autocratic society. So you can't become too successful. And so when you're index investing, yes, in a passive approach, which, by the way, I would consider fundamental investing also indexing, sort of, but that's debatable. But when you're indexing, all you want to do is capture those top growers. You want to capture those Apple, Google, those types of companies, and you don't know which ones those are going to be. This is the whole thesis of kind of spontaneous order, right? If you're a freedom person, you know what that means, and it's kind of a wonky word, but it basically just means things spontaneously happen that a central planning agency cannot predict. So, and that's the best type of growth. And so we think that the freer markets foster that type of growth and innovation because they allow their people to innovate and also incentivize that innovation. And they incentivize the people that are willing to be that top dog in whatever industry they're in. So that's what we're looking for. We're looking for the next decade's great growth stories, not the growth stories of the past. And I think in China specifically, just to go back to China for a second, that is a growth story for sure, but it's a growth story of the past. And it was a growth story of the last 30 or 40 years because the government there allowed more freedom. They allowed better policies than the policies under Mao. And yeah, Mao was a long time ago, but Taiwan being an autocracy was a long time ago too, and look how they've come out of it now. Now it's the freest emerging market, the shining light for freedom in their region. And so I think that having a freedom-weighted approach, in our opinion, the reason why we do that is that we are looking for those tremendous growth stories of tomorrow, not looking at the growth stories of the past.
So I would say on growth. So I recently published a paper in the journal Portfolio Management where we looked at country by country within the emerging market basket and say, what drives growth and how has it grown historically? Now, most of us probably have EM in our portfolio, right? You're at the session, means there's some interest and probably largely huge disappointment in how EM has performed. Which sort of takes us to the question of, has EM underperformed because maybe too many countries were autocratic, right? They just got the wrong form of government, or do they go in cycles and stuff like that? Now, when we looked at more carefully, all EM economies, autocratic or otherwise, had solid real GDP growth, far faster than the US, right? China, the last 15 years, grew on a GDP basis of 9% real per annum. And the rest of the EM is a little bit slower, but it's fine. They're all better in the US from a GDP growth perspective. But that didn't translate into corporate earnings growth. Now you kind of go, oh, why is that? Maybe because if you have a anti-business regulator, the real economy can't translate into business because you're intervening with entrepreneurs, or you're sort of messing with how people do business. So the real economy might grow, but business don't profit. When we look deeply, that's also not true as well. China, the last 15 years, so that includes quite a bit of the more recent years, had corporate earnings growth about 15% per annum. Right? The rest of emerging markets, taking out China, had corporate earnings growth of 0.5% real. So when we look deeper, like what are the factors that drive the dispersion in growth? It was not sort of the political organization. It was much more whether they had a liquid primary market, right? Because for a firm to get large and list so that you could invest in it, it has first of all to get large enough, right? So you need a venture capital market, and most of the emerging markets just don't have the depth and the capital for their market.
Let me challenge you a little bit on
Okay.
this, if that's okay, if I can intervene. I don't want to make this about me, but like one of the, I mean, I know that in your China allocations, both in Ray E and Ray C, you focus on the A share market a lot, the local Chinese companies that tend not to be the poppies with the largest flowers that are going to get their heads chopped off. But in that market, don't you worry at all about China changing its position on foreign ownership, changing the rules of the game for how you access those markets? I mean, that has evolved a lot already in the last 5 or 10 years. What's to say it doesn't evolve in a way that's negative for an investor who's put their money into that local economy?
Oh, it totally can, right? And that's why you need to be sort of tracking the ability to convert actual GDP growth into corporate earnings growth, right? Anytime there's sort of a barrier that's set up, you want to go underway, right? Just take, for example, like offshore Chinese companies. The big barrier there is most of them have this really wonky structure called IVE,
Yeah.
right? And they're not even completely legal according to Chinese jurisdictions, and that's why American regulators are looking at it as well. So, like, we would completely eliminate offshore Chinese ADRs for that reason, right? They just use a structure to sort of circumvent their own domestic ownership regulation.
Do you put Hong Kong ordinaries in that category too?
Hong Kong ordinaries are a little bit better, but a lot of them have similar structure. So we look carefully at the structure, the listing structure.
So, Perth, I want to turn that same question to you in a different angle, which is you're looking at market. Capital freedom is one of the things that I know you look at, but that also changes rather quickly. How do you stay on top of it? I mean, we just saw what happened in Russia. That happened faster than I think anybody could have predicted. The fact that we, excised them out of the global financial system.
Yeah, exactly. So freedom is a leading indicator, not a lagging indicator. So we need to get in front of that before Russia happens. Was the time to divest of Russia? So we have no Russia, no China, no Saudi Arabia, no Egypt, no Turkey. We had none of that the entire time we've been around, which is the fund has been around for 3 years. So we were able to sidestep the Russia situation and the China crash. And that has helped us. But what we care about as investors is the return, the stock market return. I don't really care about GDP growth or earnings if it doesn't lead to stock market return. And Jason, mentioned the GDP growth in China. If you look at the chart, last 30 years, it's been like this. It's very good. But if you look at the stock market return, MCHI China index, which is both onshore and offshore shares, it's very flat over the same time period. So you have a chart going like this for GDP and a chart going like this for MCHI index. And that's just not what investors are looking for. I mean, that's abysmal. It's worse than treasuries. In a time of extraordinary growth in China, investors earned less than treasuries in both onshore and offshore shares. That's both foreign investors and domestic.
So I got to correct that, which is when you have the basket of Chinese stocks, because it was compiled by Americans, by MSCI, is dominated by offshore issues that they have access to, and that's sort of liquidly available for American investors. But frankly, you want to look at all the shares that the actual local investors invest in, right? So the A shares, over the last 15 years, A shares is the only market in a total return perspective that actually outperformed the U.S. the last 15 years by about 1.5%.
What happens if you go back 30 years?
Well, if you go back 30 years, you got to start at a time when that market actually has liquidity. Right? You can't go back to a point in time when that stock market has like 3 stocks.
Okay, so it's only had liquidity for 15 years, is what you're saying?
Yeah.
Okay.
Well, I mean, and
just checking.
To be fair, 30 years ago, we didn't have ETFs in this market either.
Okay.
I mean, so, a lot has changed since then. But let's switch gears a little bit. So you both run funds that compete with some big names out there in the emerging market space, right? I'll go ahead and name tickers like EEM, IEMG, like default allocations for a lot of advisors. Both of your funds, certainly in the recent period, have outperformed those sort of sort of truly passive ways of just cap weighting all of the emerging markets together. To what do you attribute that outperformance? Because it's obviously got to be different, because you're 30% in China and you're 0% in China, and you're both beating the broad index.
Well, he's 100% China.
Well,
Oh,
no,
no,
I'm talking
REM.
RE.
Oh, okay.
I'm talking about the apples to apples comparison here, which is an advisor making an allocation for EM. They're 5 or 10% that they're putting in there. You both beaten, but why? Because you're utterly different in how you're approaching it. So Perth, is it just avoiding Russia? Is it just avoiding?
It's also that the freer markets, they have more sustainable growth. They recover faster from drawdowns. So if you look at the 2020 recovery, the freer markets strongly outperformed EM, IEMG, even ESGE and the ESG strategies, and even ex-China. So it's not even just about China. And it never has been. We never excluded China arbitrarily. It was always a natural result of the freedom weighting methodology, which is just a mathematical process.
Data-driven.
Yeah,
Right,
so
right.
it's not excluding China, Russia, Saudi Arabia, or any country arbitrarily. But that has helped. Now, this year, we're getting a lot of outperformance from Chile, one of the freer emerging markets. When I say freer, it's all relative, right? There's no 100% free country. There's no 100% unfree country. Like, we're not 100% free even here. So it's all relative, and we just invest in the freest emerging markets. Chile has outperformed this year because of their commodities exposure. So it depends on the country exposures as well. So it's not just that we're excluding the countries that have done poorly because of freedom issues, although the thesis did play out much faster than I anticipated. But we are also capturing those markets where investors can capture return and can capture value and do experience faster recoveries and more efficient use of personal and economic capital due to the freedom levels that they have.
Okay, so from your perspective, it's a country weighting issue, and you got the right call. Jason, what's the secret of your success recently in RE?
Yeah, so for us, it's about the underlying corporations, right? Because across emerging markets, you have a lot of state-owned enterprises, right? And state-owned enterprise, whether in a more autocratic country or in a more democratic country, they behave like an arm of government, right? The political party has a lot of say in what they do, right? You take Brazil, right? A lot of Brazil state-owned enterprises is fraught with corruption. So for us, it's looking at the companies and say, well, which one is actually generating growth, right? Which is improving the livelihood of their workers, is delivering value to their society. And so we overweight those that drive growth and underweight those that are basically duds within those economies. So for us, it's more looking at firms that drive growth and add value than making a judgment at the country level.
So it's just, from your perspective, pure active management stock selection. That's what you think the answer has been there? And is it, we've talked about this before. I'm a bit of a pessimist on active management as a prior, just because I can do math and I see things that have happened in the more developed markets. You're making the case that this is one of those places where active management can really work because, the old story, it's just uncovered. Nobody's looking at it. Is that really true?
Yes. So if you think about alpha, right? Alpha, zero-sum game, right? When we look at S&P 500, both sides of the trades are institutional. So you're not going to earn alpha from anyone, right? Not consistently. In retail markets, especially the Asian retail markets, there's a lot of retail gambling. Like in China, it's 85% retail. In Taiwan and South Korea, it's 50 to 60% retail. So you kind of have a willing reservoir of losers on the other side. and that's really what's happening.
So we need more losers. I got it. Barth, you were going to say?
I kind of actually agree with that.
I mean, people make that argument about, markets in the U.S. when they get a little hinky too. I mean, that was
Robinhood.com.
Yeah, exactly. Exactly. Okay. Well, so with that in mind, why isn't the best strategy to somehow merge the two of you together and take the active management at the country level, but then do the reweighting based on freedom scoring? Have you guys thought about getting married in that regard?
We haven't, but hey, that's always, there's always a next idea.
All right. Well, I do want to turn to some of the Slido questions here. Thank you for being good sports, everyone. I can read a few of these. On the bottom, we have what's it gonna have to change? What's it gonna take for emerging markets to actually outperform? And I'm guessing we're saying outperforming a diversified basket of domestic stocks, which for the last couple of years has not been a winner on the emerging market side. So what do we need to see?
For me, it's really excluding countries or industries that just have low growth. There are a lot of stuff in EM that just don't grow. If you look at an EM basket, it looks like nothing, to the underlying real economy. It's a lot of big state-owned enterprises are just really inefficient. And so you want to get rid of that within certainly your EM basket as kind of the starting point. and markets that just don't have liquidity, meaning there's no point for anyone who's successful to actually seek listing because they don't get liquidity, they don't get a multiple, so they're not going to list. Right? You want to focus on a country where it makes sense for an entrepreneur to list and unlock value for shareholders, and then also, of course, focus on those that actually do grow over time.
I mean, Perth, what do you think? What do we need
Yeah,
to have
I mean,
as a category for this to
I don't know what's going to cause emerging markets to outperform it. I think they're obviously due, and we are very optimistic because these are the countries that in the world are contributing the most to GDP going forward, and they have much better demographics and growth profiles than developed markets. I do think that a lot of these bigger emerging markets that are going backwards in their policies to become more autocratic are very dangerous as an autocracy drag on the emerging markets baskets as a whole, especially if they have a large allocation. So we try to avoid that autocracy drag going forward and try to capture, markets that have stronger institutions, rule of law, private property rights, intellectual property rights, just as better shareholder rights in general. And we think those are going to be the safe havens in a crisis, but also the places where we'll find, the growth stories of the next decade. Like I said, in a basket, in an index, we don't know what's going to go up. We don't know when it's going to go up. We just diversify. We have our allocations. We stick to the plan. And when it does, break out, we want to be in places where we can capture that growth. And we think that the freer emerging markets are where that is.
So I want to add another dimension to what Perth is talking about. And I would say if you really want to cut up the emerging markets, a way to cut it up is there's a part of emerging markets that actually emerge. And oftentimes we refer to that as emerging Asia, right? Because Japan was once emerging Asia and emerged. And then you got South Korea, you got Taiwan, they're all borderline emerging or having emerged. And you got China emerging, right? And then there's the part of emerging markets that don't emerge, right? They're very cyclical.
And they sit there.
They're just commodities play, right? Commodity has a great day, it has a great day, but there's no value on those economy. And the dichotomy there really is kind of the Asian emerging markets have a bit of this engineering mentality, right? Like learn from the US, learn the business process, learn the engineering process, see if you can do it cheaper, right? Maybe you can just outwork someone 80 hours a week and squeeze out a margin. So those tend to be reliable growers over time, and that's what we look for. And the other ones are really just always so captive to the market super cycles.
Natural resources.
They never actually grow.
Yeah, I mean, I'll address that a little bit, but the freer markets, even if they have commodities, right, they're less commodity dependent, so they're less natural resource dependent. You have a market like Russia that's basically like, what's it called, an army with it's like a gas tank with a, like gas station with a military.
Gazprom with an army.
So yeah, I mean, so that's very, it's addressable through using freedom metrics because the freer countries and I agree with you that a lot of Asian economies do have technology and innovation, and you see Taiwan producing chips for the world. You see Indonesia hugely benefiting from this decoupling that's going on from China, and even Vietnam, which was frontier, so not related to any of the emerging that we're talking about here. But a lot of the ASEAN countries are benefiting from this trend going forward. So there's a lot of ways to capture growth, even in this kind of a crisis environment. So I think that it is still possible, but I don't know when the breakout's going to be.
Well, I'm going to ask this first question we have here too, which is a similar kind of question, which is what do you say to people who say emerging markets are great, but not now? Like, I'll get back to it, or I'll pick a time to enter. Yeah. Is it possible? I mean, in general, market timing is a fool's game, but is it possible to really get a timing signal for emerging markets?
You want to start?
Yeah, I'll start.
Okay, so I mean, I'm from Texas, so most of our advisors don't invest in emerging markets. So I would say, that's we're here for people who are always strategically allocated to emerging markets. So if you're not always strategically allocated, you're going in and out, and that's your strategy. But we're here for the strategic allocators. So
you don't think it's You don't think it's timeable?
No, I don't think it's timeable.
Jason?
I would say generally you want EM as a part of your strategic core, just because, look, it's a diversifier, especially for the part of EM that's decoupling from the US, right? There's a lot of EM that's very contingent on US because they export too much to the US, so you don't get a lot of diversifier. You do want to focus on an EM that is kind of decoupling from the US because that's what's going to get you diversification, right? Just different growth paths. So I would say, when you pick your EM, you got to think about which way to manage EM gives you that low correlation. So that's important for strategic asset allocation. If you absolutely have the time, just because ETFs easy to sell in and out of, buy it when other people don't want it, right? There probably isn't a great strategy for timing,
Well,
but this may be the most reliable one.
That's what rebalancing does,
Yeah.
right? You end up being the buyer when it's down. A couple more quick ones here before we run out of time. Perth, what do you say about countries where you've got sort of mixed freedom? Somebody gives the example of Singapore, where obviously we've got basically free capitalism, but not quite the political freedom we might expect in, here or in Europe or something like that.
Yeah, so Singapore is like the Disneyland with a death penalty, right? So, so yeah, that's a very special case, and I'm glad that Singapore is a developed market, so I don't have to deal with that case. But yeah, that's very interesting, and I think China sometimes want to base their model on Singapore, but it doesn't work as well in China because China's so big. But yeah, no, that's a very special case where you have a lot of economic freedom, like highest in the world. Now, every businesses in Hong Kong are all going over to Singapore as a result, but very low personal freedom. And so, yeah, it's a very special case, and it's not one that we have to deal with because it's not in our universe.
So no
thankfully,
obvious answer.
yeah, I don't know.
Jason, I wanted to come back to you. You're one of the smartest quants I know. We have a question here about how you think about this in a dollar perspective, right? We are obviously in a pretty crazy currency environment. There are people who take the approach to emerging markets and international developed to hedge at least some or all of that risk out. How do you think about investing now with the dollar as strong as it's been?
Yeah, so, stronger the dollar, the better it is usually for export-oriented emerging markets. So you look at the correlation of markets between, Taiwan, South Korea, and China. They tend to do well when their currency is weaker, just because they export so much. So, in that sense, a strong dollar is actually great for both sides of the trade, right? Americans love it, right, because we can just buy more stuff. And the exporters love it because they can export at a better price and maintain a margin.
That works really well if you have more free trade, which is one of our metrics.
Got it. All right, last question here. I'm going to interpret it from the 3 words on the screen I can read here. I think it's asking about data. And the 2 things that I want to ask you about data is, Perth, obviously you're using freedom metrics. I think a lot of folks hear that and they think, oh, this is just somebody making a survey and deciding.
Yeah.
And Jason, from your perspective, you're an active manager, so I think a lot of people may think you're shooting from the hip, and I know that's not true either. You're quite a fundamental and quantitative guy. So I'd love to just hear about what data you look at in your approach that you think is most interesting that other folks might be able to go poke at and get some information from. So Perth, I'll start with you.
Yeah, so I think so I'll answer your question first, but I can read this a little better, and I'll read this for you in just a second. And it's a good question. So as far as your question, our data is third-party quantitative objective data from the Cato Institute and the Fraser Institute. They're the only ones who do both personal and economic freedom. So we categorize that into civil, political, and economic freedoms. There's 79 different metrics. Civil, like terrorism, trafficking, torture, women's freedoms. Political is freedom of speech, media expression, religion, assembly, civil procedure, criminal procedure. And then economic freedoms we're all familiar with: taxation, rule of law, business regulations and practices, private property rights, freedom to trade internationally, and so forth. Sound money. And then one of the things that you can dig deeper into there, if you go to lifeandlibertyindexes.com, go to FRDM index, these are all listed on there. And we use this third-party data so that we can have complete objectivity. So that's where we get our data, and you can dig deeper into each of those metrics. But the question, I think, was asking, like, in a country like China,
how can you trust the data?
Yeah, how can you trust? Like, are you concerned that you can't trust the data? And I think that's a very valid question, because there have been a lot of data from China, whether it's COVID deaths or whether it's GDP or whether it's whatever, number of people locked up and whatever. So there are things that are questionable out of companies and governments where there is no freedom of press or freedom of expression for people to kind of independently verify that data. So if there's no method of independent verification, which means no free press,
I want to make sure we get a chance for Jason because we're out of time.
There's no accountability.
We're over time.
Sorry, go ahead.
So, our starting point, so we're quantitative, right? So it means we use a lot of data. And so any quant knows that the first thing to get right is to get the data right. So we're always very suspicious of data that we get, whether people sell it to us or we get it for free. So the first thing is to say, does the data make sense, right? Can I correlate that to reality? Does that translate into stock market reaction in a consistent way? And so the first thing we do is just massive amount of data correction. In a funny sort of way, China has a lot more data readily available. It's noisier and it's dirtier. It's shorter for sure. But just because they started in the digital age, so they just keep track of crazy amount of data. And if you ask for it nicely, they'll all give it to you, right? Their data privacy is not high on the list. And so there's just a lot more data for us to look at, to triangulate and get a sense of, what's true, what's not true. And if you have enough data and look at it hard enough, you can triangulate the truth.
All right. Well, we're out of time, Perth. Jason, this has been an absolute blast. Thanks, everyone. Thank you, everybody, for coming.